Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Digital Turbine.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And real quick, just to set the stage, we are using StockOracle for some of our insights today.
Right, which is an AI-aided stock research platform. Definitely not financial advice or, a trading signal service.
Exactly. It's not real-time market data either. And keep in mind, AI insights and valuation estimates can be incomplete or just wrong. So always verify important facts yourself.
For sure. And if you want to check it out, there's a special 14-day trial link below in the description. Just a heads up, that is an affiliate link, so the channel may earn a commission at no extra cost to you.
All right, so Digital Turbine, ticker symbol APCS.
Yeah, APPS. So you know that feeling when you unbox a brand new smartphone, you peel off that satisfying little plastic film, power it up, and it just feels like this pristine blank slate.
Oh, yeah, it's a great feeling. Totally uncluttered, just a fresh start.
Right. But then, you swipe over to the second or third screen, and the illusion completely shatters. Sitting right there are like 3 mobile games you've never heard of, a random hotel booking app, and maybe some discount shopping service you definitely never asked for.
Ah, the infamous pre-installed apps. Suddenly your blank slate is, it's prime commercial real estate. Someone already built a mini shopping mall on it before you even walked in the door.
Exactly. And most of us just drag those icons into a little folder labeled junk, or we delete them and move on. But behind the scenes of those little icons is a multi-billion-dollar war for your attention.
It really is a war.
And today, we're taking a look at one of the generals fighting that war, which is Digital Turbine. And honestly, it is a wildly volatile mobile ad tech company.
Yeah, they operate entirely in the background of your digital life. You, as a user, you don't really interact with Digital Turbine directly.
No, not at all.
But the financial mechanics driving their business are, they're anything but quiet.
Oh, they are making a lot of noise. Following their August 2026 earnings, they posted a 30% after-hours surge. The headline numbers were just flying.
They were.
But there are some hidden red flags here that completely change the narrative. So whether you're looking for the next AI-driven tech play, or you're just curious about how those pre-installed apps actually make money, this is going to be a real lesson in reading between the lines of a glowing press release.
For sure. And to really understand how they generated that massive stock surge, we first have to talk about their moat, their competitive advantage, because you can't just build an app and force it onto someone's home screen.
Right. Apple and Google won't just let you do that.
Exactly. So Digital Turbine's core business model relies on deeply embedded structural relationships. They partner directly with the device manufacturers, the OEMs like Samsung or Motorola, and the cellular carriers like Verizon or AT&T.
Which is incredibly hard to do. Those are massive corporate partnerships that take years to negotiate.
Oh, absolutely. But because they have those deals locked in, they basically hold the keys to the kingdom. They can pre-install apps right onto the device at the factory level.
Right.
Yeah, before you even buy it. They call it their on-device solutions segment. And it completely bypasses the friction of making a user go to the App Store, search for the app, and click download.
Which is a huge advantage for advertisers. Yeah. But they don't just stop at pre-installing apps, do they?
No, and this is where the real growth is coming from lately. They also run programmatic ad monetization through what they call their app growth platform.
Okay.
Essentially, they auction off ad space in real time. So that dual approach, controlling the real estate on the device and running the ad network that feeds into it, is incredibly difficult for a new competitor to just swoop in and replicate.
Okay, let's unpack this, because this is where the headline triumphs start to clash with the underlying reality. You mentioned the app growth platform. Let's look at the numbers that made Wall Street lose its mind. Give us the stats for Q1 of fiscal year 2027.
Well, the top-line numbers were robust. They posted total revenue of $166 million for the quarter.
That sounds huge in isolation, but what's the context there? How fast is that actually growing?
It represents a 27% jump year over year. But the real star of the show, the metric that caught everyone's attention, was that app growth platform we just talked about.
Right.
That specific segment skyrocketed by 56%, bringing in $56.6 million all on its own.
A 56% growth rate in one quarter is the kind of number that makes investors instantly hit the buy button.
Yeah.
And based on the data, a lot of this hypergrowth is being fueled by their new artificial intelligence partnerships.
which is, becoming a very common theme in tech right now. But the mechanism is actually pretty interesting.
Yeah, they aren't just slapping the word AI on their website. The way I understand it, with AI optimizing all this user data, they are acting as a highly efficient matchmaker. Because they sit at the device level, they have access to immense amounts of data regarding how people interact with their phones. So they feed that data into AI models to instantly match advertisers with the exact users who are most likely to click and buy.
You've hit on the critical mechanism there. I mean, traditional advertising is often like throwing spaghetti at a wall to see what
Right,
sticks.
just hoping someone cares.
Exactly. But AI changes the physics of that wall. It analyzes thousands of microvariables in milliseconds. So it ensures that the ad for, say, a new strategy game only appears in front of a user whose past behavior indicates they actually play strategy games. That hyper efficiency is what drove that 56% surge.
But wait, if they are making all this money and the AI matchmaking is working perfectly, why did you mention hidden red flags earlier?
Ah, well, what's fascinating here is how that top-line matchmaking success distorts the bottom-line reality. This is where we run into what I like to call the profitability illusion. We need to talk about the gap.
Okay, the gap between GAAP generally accepted accounting principles and non-GAAP figures. For anyone listening who isn't a CPA, what exactly does that mean in plain English?
Think of GAAP as the strict, standardized rulebook of accounting. It's the unvarnished truth. Non-GAAP, on the other hand, is the company's customized version of their financials.
Aha.
It's where they are allowed to say, hey, if you ignore these specific one-time or non-cash expenses, here is how our core business actually performed.
So it's basically the if you squint and tilt your head, we look great version of the math.
That is one way to put it. If you look at the headline of Digital Turbine's press release, they reported a massive 69% increase in something called non-GAAP adjusted EBITDA, bringing in $42.5 million.
Wow. Okay.
They also reported non-GAAP adjusted net income of $24.1 million. So if you stop reading right there, it looks like a wildly profitable enterprise.
Right. They are telling the market they made over $40 million in adjusted profits.
Mm.
But what happens when we look at the strict, standardized GAAP rulebook?
When you look at the actual GAAP numbers, they posted a net loss of $3.2 million.
Wait, really?
Yes. On paper, under standardized accounting rules, they literally lost money for the quarter.
I have to admit, when I see a company loudly broadcasting that they made $42 million on one line, but the rigid math says they lost $3 million on the very next line, my skeptical alarm bells start ringing. How do they justify a gap that wide? Like, what are they stripping out of the math to make themselves look profitable?
The biggest culprit in these tech earnings, and specifically for this company, is almost always
Stock-based compensation.
precisely paying employees in stock instead of cash. To keep their top talent, especially the AI specialists who are building this 56% growth engine, they have to pay them incredibly well.
Right. Tech talent, it's expensive.
Exactly. But instead of draining their cash reserves to pay high salaries, they issue them company stock. So in a non-GAAP world, management argues, hey, this isn't a cash expense. It didn't leave our bank account this quarter, so let's just adjust it out of our earnings to show you our core operational performance.
But I'd argue that is a deeply flawed way for an investor to look at a business. Stock-based compensation is a real cost to the shareholders.
Oh, absolutely.
I mean, let's use a pizza analogy. If you buy a slice of a pizza and you own 10% of that pie, you feel pretty good.
Yeah.
But if the company keeps baking new, smaller slices to hand out to their employees every quarter, your slice is getting diluted. You own less and less of the total pie. You might not see cash leaving the bank, but your ownership stake is absolutely paying the price.
Dilution is a very real, very heavy cost, and this is why it's so critical to understand structural unprofitability. When we zoom out beyond just one quarter and look at the trailing 12 months, their earnings per share, their EPS, is a negative 34.7 cents. Yeah, and their actual net margin is negative 6.68%.
So for every dollar they bring in, they are actually losing about 6.5 cents.
Under GAAP rules, yes. Now, to be fair, their price-to-sales ratio, which measures how much investors are willing to pay for every dollar of revenue the company generates, is sitting at 1.93.
Meaning you pay roughly $2 for every $1 of sales they make. Which, I mean, that actually seems quite reasonable, maybe even cheap, for a tech company growing revenue at 27%.
It is relatively cheap, but the catch is that you're paying for a business that, despite the massive AI tailwinds and the impressive revenue growth, still cannot turn a true GAAP profit on paper, mostly because of how much they have to pay their employees in stock to keep the engine running.
Which makes the stock market's reaction to all of this even more fascinating to analyze. I mean, if the company is technically losing money on paper, how is Wall Street reacting? Are investors buying into the AI hype, or are they panicking over the gap losses? Let's look at the technical setup and the sentiment, because this chart is, well, it's all over the place.
The volatility here is extreme. At the time of this talk, the stock is trading around $9.51. It is up 80% year to date.
That's huge year.
It is. But if you look at just a 13-week period leading up to these earnings, it surged an unbelievable 155%. It bounced off a 52-week low of just $2.74, yet it's still well below its July peak of $13.60.
So it went from roughly $3, shot past 13, and is now settling around 9. That is wild whiplash.
It really is. And if you want to understand just how volatile this stock is compared to the rest of your portfolio, the data points out a beta of 2.99.
Okay, let's clarify beta real quick. Think of beta as a financial magnifying glass for volatility. The broader market, like the S&P 500, is assigned a beta of exactly 1.
Right. So a beta of basically 3 means that whatever the broader market does, Digital Turbine's stock movement is magnified 3 times over.
Wow.
Yeah. If the market goes up 1%, the stock tends to go up 3%. But if the market drops 2%, it plummets 6%. It moves 3 times as fast in both directions.
The highs are incredibly high, and the drops are terrifying. It requires a strong stomach, for sure. But here's where it gets really interesting to me. It's how totally divided the professional analysts are on how to value this company. It's like a split screen.
Very much so.
You have the major Wall Street firms playing cheerleader. Benchmark initiated coverage with a buy rating and a $15 price target. Roth Capital set an $11.50 target.
Both of those targets imply significant upside from that current $9.51 price point. Wall Street is clearly looking at the 56% growth in the app segment and betting that the AI momentum will eventually outrun the accounting losses.
But then you look at independent voices, and it is a total civil war. On the exact same platform, around the exact same time, you have one analysis titled Deep Value Buy Opportunity, arguing the stock is a steal. And right next to it, a downgrade article titled Don't Look Under the Hood, arguing the fundamentals are rotting. Half the market thinks it's a gold mine, the other half thinks it's a landmine.
Which, if we step back, is a perfectly natural reaction to a company presenting stellar top-line growth and miserable bottom-line GAAP realities. The market is aggressively trying to figure out which metric actually matters for the long-term survival of the business.
But if Wall Street is divided, what are the people inside the building doing? Because this is where the story gets a major wrinkle. While the analysts are fighting it out, the executives and board members who see the daily dashboards are quietly making their moves.
And what does the insider flow show us?
Over the last 90 days leading up to this earnings report, company insiders have net sold 27,673 shares. And in that entire 90-day window, there were 4 separate sell transactions and exactly 0 buys.
We need to add some analytical nuance here so we don't jump to conclusions.
Fair enough.
The absolute dollar amount of that sell-off is relatively small when you consider this is a $1.09 billion market cap company. Executives sell stock for all sorts of mundane reasons, buying a house, paying taxes, or just diversifying their personal portfolios. We shouldn't automatically panic at the word sell.
I agree that executives are allowed to take profits, but 0 buys. I mean, not a single share purchased when the stock was sitting down at $3, $4, or $5.
That is the crux of the issue. It's the information asymmetry. The insiders have access to data that retail investors only get to see every 3 months. The one-sided nature of this selling is a glaring yellow flag. Management just raised their full-year guidance to the public. They are projecting up to $670 million in revenue. They are touting these incredible new AI matchmaking tools. The narrative they are selling to the street is overwhelmingly confident.
Exactly. If you have the winning lottery numbers in your pocket, you buy more tickets. If the AI tailwinds are as certain as they claim, and the company is supposedly rocketing toward that $15 price target, why aren't the executives putting their own cash on the barrel at $9.51?
It strongly suggests a lack of conviction at this specific price level. It implies that while the executives might genuinely believe in the long-term vision of the company, they also recognize that the recent 155% rally has fully priced in or maybe even overpriced their recent successes.
Hmm.
They are taking some chips off the table rather than pushing them all in.
Which puts an immense amount of pressure on their future performance. Because if the insiders aren't buying, the burden of proof falls entirely on the company's ability to keep dropping these jaw-dropping earnings reports quarter after quarter. The margin for error is basically zero.
Precisely. And that brings us to the path forward and the high-stakes risks looming over their next moves. The absolute critical catalyst here will be the Q2 FY 2027 earnings, which are expected in early November 2026.
It's like a blockbuster summer movie franchise. Q1 was a smash hit at the box office. Everyone loved the special effects, the 56% growth, the AI matchmaking. But now they have to produce the sequel.
Right.
And if Q2 isn't just as good, or better, the investors will instantly walk out of the theater, especially with that high beta of 2.99 magnifying every reaction. If they miss expectations by even a little bit, that beta is going to drag the stock down 3 times as fast as the market.
For this stock to reclaim those $13 highs, management has to prove to the market that the 56% growth wasn't just a one-quarter fluke driven by a few lucky ad campaigns. They have to show that their AI optimization is a durable, long-term engine. And arguably most importantly, they must show sequential progress toward closing that unprofitability gap.
They need to show that they can eventually make real, standardized money, not just adjusted money.
Yes. But let's explore the bear case here. What happens if they stumble? This raises an important question that every investor needs to ask before jumping into a hype rally. What if the AI-driven ad optimization hits a ceiling?
That's a scary thought.
AI makes your targeting more efficient, yes, but there is a physical limit to efficiency. Once you've perfectly optimized the ad placements for every single user, growth has to come from somewhere else. You need more users, or you need to charge more for the ads.
And their legacy business isn't exactly a rocket ship right now. The on-device solutions segment, which is the actual pre-installing of apps on new phones, that only grew at 15%.
Which is healthy for a mature business, but it's not the 56% hypergrowth that Wall Street is currently pricing in. Furthermore, we have to look at the brutal competitive landscape they are operating in. The mobile ad tech market is dominated by behemoths. Google and Meta have essentially limitless resources, billions of dollars, to pour into their own AI ad optimization.
And Digital Turbine has that pre-install moat, but Google controls the entire Android operating system.
Exactly. Digital Turbine is fighting a war on 2 fronts. They're trying to maintain their pre-install leverage with the device makers, while simultaneously fending off the biggest tech companies in the world in the programmatic ad space. If Google tweaks its algorithm or Meta rolls out a more efficient AI model, that 56% growth could just evaporate.
Wow.
And if that growth slows down even a little bit, the current rally will suddenly look like a massive overreaction where all the good news was already baked into the price.
So what does this all mean for you, the listener? Let's pull all these threads together into a final verdict. The StockOracle platform gives Digital Turbine a cautiously bullish rating of 7 out of 10. And honestly, I think that perfectly captures the profound tension in this stock.
I agree.
On one hand, you have undeniable momentum. They have a deeply entrenched position on our actual smartphones and a really compelling AI mechanism that is clearly driving massive top-line revenue growth right now.
But on the downside, they are weighed down by persistent standardized gap losses. They have structural dilution from heavy stock-based compensation, and they have the undeniable caution signal of one-sided insiders selling from the very people who know the company best.
For anyone tracking tech stocks, this is such a vital lesson in how to read financial reports. You can never just stop at the headline earnings beat. You have to walk down the income statement and check the GAAP numbers to see if they're actually making money or just playing with the accounting. You have to watch the insider flow to see if the people in charge actually believe your own hype enough to buy the stock. And when you see a company bounce 155% in a few months, you always have to ask yourself if you're arriving at the party right as all the good news has already been priced in.
If we connect this to the bigger picture, the entire mobile ad tech landscape is in a massive transitional phase. The privacy changes initiated by Apple and others over the last few years made traditional targeted advertising incredibly difficult. First-party data became scarce. Because of that, AI optimization isn't just a fun new feature for these ad companies. It is becoming the only way to survive.
Yeah, adapt or die.
Exactly. Digital Turbine has proven they can use AI to squeeze more value out of the specific on-device real estate they control. The long-term view really hunges on whether they can do it profitably against competitors with much deeper pockets.
And that brings me back to where we started today. That brand new, pristine smartphone right out of the box. Digital Turbine has built an incredible business acting as the middleman, turning those blank screens into hyper-targeted billboards. But it leaves me with this one final, provocative thought for you to mull over.
What's that?
As artificial intelligence makes programmatic advertising increasingly automated and efficient, will middlemen platforms like Digital Turbine remain the most valuable real estate agents on our devices? Or will the massive hardware giants who actually build the phones, the Apples, the Samsungs, the Google Pixels, eventually look at all that massive ad revenue, decide they don't need a middleman's AI anymore and just build the technology to take that real estate for themselves?
It's a billion-dollar question for the future of mobile tech.
It really is. Remember, if you enjoyed today's talk, please subscribe, like, and comment underneath. And don't forget to check out the special 14-day trial link for StockOracle down in the description to run your own analysis. Until next time, keep digging.